Now let's talk about calculation of basic EPS. So just to give you a quick context of where we are, we've talked about so far revenue recognition. So how do we recognize revenue? We've talked about various kinds of expenses and how they are dealt with. And now we are going to talk about one of the most important numbers in financial analysis, which is EPS, or earnings per share. And essentially this is telling a shareholder that for every share that he or she owns, and this is ordinary shares or common shares, so for every share that he or she owns, how much earnings do we have? So earnings per share is a corporate profitability performance measure for publicly traded firms. It is reported only for common stock. And here is an extremely important formula that you must memorize very well. Basic EPS is equal to the net income minus preferred dividend divided by the weighted average number of shares. Weighted average number of shares is the number of shares outstanding during the year weighted by the portion of year they were outstanding. So let's look at a few examples now to understand this. I'm going to use example 14 from the 2011 curriculum just to illustrate this point. Let's say a company has net income of 2.5 million. The preferred dividend is 200,000. On 1st January, the number of shares outstanding were 1 million. On 1 April, 200,000 new shares were issued. And on 1 October, the company bought back 100,000 shares. So recall from an earlier session that this repurchase of shares is called a Treasury stock operation, and this reduces equity. So it reduces the number of shares outstanding and hence reduces equity. So what is the formula for basic EPS? As we just saw, the basic EPS is net income minus the preferred dividend divided by the weighted average number of shares outstanding. So let's plug in now. What's the net income? The net income is 2,500,000 minus the preferred dividend, which is 200,000, divided by the weighted average number of shares. So what is the weighted average number of shares? Let's do this calculation here on the left. On 1 January, the number of shares outstanding was 1 million. So we had 1 million shares. How long did we have 1 million shares for? We had these for 3 months. Why? Because on 1 April, 200,000 more shares were issued. So what we say here is 1 million for 3 months out of the total 12 months in a year. Then we had 200,000 shares issued, which makes the total number of shares outstanding equal to 1,200,000, and we had these for 6 months. Notice that the 100,000 shares were repurchased on 1st October. So from here to here is 6 months. So 1.2 million shares for 6 months. And then after the repurchase, we are down to 1,100,000 shares, and we had these for 3 months out of 12. So if we do this calculation, what we will see is that the weighted average number of shares is equal to 1,125,000. So I would suggest you pause the video and make sure that you can come up with this number. So weighted average number of shares is 1,125,000. You plug this in over here. So 1,125,000, and this gives you a basic EPS equal to 2.04. So if you didn't fully get this, pause over here and make sure you get this basic EPS calculation before moving on. Stock dividends and stock splits. A stock dividend is the distribution of additional shares to each shareholder in an amount proportional to their current number of shares. So if a 10% stock dividend is paid, the holder of 100 shares of stock would receive 10 additional shares. So notice here that no extra money is paid out and no wealth is created over here. So if you, for example, had 100 shares where each share is worth $10, then your wealth would be equal to 1,000. After the stock dividend, your wealth would remain equal to 1,000, but now you would have 110 shares. So the value of the share, let's say X, could be determined by this simple equation: 100x is equal to 1000, and the new share price X would simply be 1000 divided by 110. So notice that your wealth remains the same. Number of shares goes up by 10%, so effectively the share price would come down accordingly. A stock split refers to the division of each old share into a specific number of new shares. So the holder of 100 shares will have 200 shares after a 2-for-1 split. That means that for every share that you had, let's say that initially the share was worth $10, then after a 2-for-1 split, that one share will now become equal to 2 shares, each worth $5. So this is a 2-for-1 split. If you had 100 shares like this, you will now have 200 shares, because for each one you now have 2. If a company announces a 3-for-2 split, this means that for every 2 shares that you have, these then become equal to 3 shares. So this is a 3-for-2 split. 3-for-1 split would mean that for every 1 share you now have 3 shares, and so on. Why do companies do this? The general idea is companies like to keep their share price within a certain range, for example between $20 and $80, and if companies estimate that the share price is going up a lot, then they will do a stock split. If a company like Microsoft never did a stock split, the stock price would be worth thousands of dollars today, and hardly anybody would buy a share worth thousands of dollars. So is there any fundamental difference between stock splits and stock dividends? For our purpose, in terms of everything that we need to do in this reading and in general in the CFA, they are essentially equivalent. However, if you are an accountant, then the treatment of stock dividends, accounting treatment of stock dividends and how they are shown on the balance sheet is somewhat different. We don't need to get into that right now though. So let's do the same example we just saw with a stock split, and remember the EPS, the basic EPS was simply equal to net income minus preferred dividend divided by the weighted average number of shares outstanding. The numerator does not change with the stock split. You still have net income, that is 2.5 million, preferred dividend which is 200,000. So that number does not change. What changes is the denominator. And let's look at the numbers now. So we still have 100,000, we still have 1 million shares at the start of the year. As before, we have 200,000 new shares issued, and this is new. Let's say that there was a 2-for-1 split on 1 July, and then after the split, the company repurchased 100,000 shares. So how does this impact the weighted average number of shares? And for now, just take my word for the fact that the way you do this is you apply this split to everything that you see before the split, and what happens after the split remains as is. So the 1 million shares Now since you are doing a 2-for-1 split, you apply this retroactively. So you apply this to everything that happened before. In a 2-for-1 split, the 1 million shares need to be looked at as 2 million, and then new shares issued 200,000. So here again, given the 2-for-1 split, this means that the 200,000 becomes 400,000. So we now have the total number of shares goes from 2 million to 2,400,000. But after the split, we only have after the split, now the 100,000 is in the post-split world. So this is a treasury stock operation. The 100,000 remains 100,000, and the shares come down to 2,100,000. In terms of calculating the weighted average, we have 2 million for 3 months as before, so from 1st Jan to 31st March. So you multiply this or weight it by 3/12. The 2,400,000 is for 6 out of 12 months, and the 2,100,000 is for again 3 out of 12 months. And as before, you add these numbers. When you add these numbers, you get 2,275,000. The net income minus preferred dividend is the same as what we have before, so this is 2.3 million. So if we do 2.3 million divided by 2.275 million, the answer that you will get here is 1.01. Notice that this is roughly half of the EPS that we saw earlier, which was 2.04. And this makes sense. Roughly speaking, we have twice the number of shares now, and the numerator, which is the net income minus preferred dividend, has stayed the same. So after a stock split, the earnings per share will obviously go down. So that's your basic method for calculating earnings per share when there is a stock split. People get confused about this, but for now just take this as a given. As a quick explanation, the way you can think of it is, whenever there is a split, all previous prices then need to be split adjusted. So let's say that a stock was trading for $10, and then on 1 July there was a 2-for-1 split. So the price now, let's say, has not fundamentally changed. So if there is no change in price after the 2-for-1 split, the stated price in the market will be $5 per share. Now if somebody asks you on 1 October what the price was on 1 Jan, what will you say? Will you say $5 or $10? And the answer is that we always talk in terms of split adjusted prices. So previous prices will now also, the price on 1 Jan will be stated as the split adjusted price, which is $5. Why? Because if you say that on 1 Jan the price was $10, that would be extremely confusing, because it would then seem that the price has gone down from 10 to 5, which is not really true. The price is now 5 because of the split. So to keep comparability straight, we need to report all previous prices as split adjusted prices. So what was trading for $10 on 1st Jan will now be quoted as $5. So any stock charts that you will see will all show past prices that are adjusted for splits. Now after the split, if the stock price goes up, then obviously, so if this price now goes up from 5 to 6, then after the split you obviously are showing the price the way it is. So I hope that made sense. That is approximately the reasoning behind why we make adjustments prior to the split but not after the split. Let's now talk about the concept of EPS dilution, and we will do so with some convertible preferred shares. Again, the net income is 2.5 million, preferred dividend is 200,000. Now that you've understood the concept of weighted average shares, we will keep things simple by saying that the weighted average number of shares for the year is simply 1 million. But to understand this concept of EPS dilution with convertible preferred shares, we'll say that the company has preferred shares which are convertible to 400,000 common shares. So what is the EPS if these shares were to be converted? So now, as an analyst, you have already calculated, or let's say as an analyst, the first thing that you would do is calculate the basic EPS, which is equal to 2.5 minus 0.2. So 2.3 million in the numerator divided by the number of shares outstanding, 1 million. So divided by 1 million, so your basic EPS is equal to 2.3. But as an analyst, you say that what if these shares are converted to, the preferred shares are converted to common stock? To come up with the new EPS, we use a method called the if converted method, where we essentially say what happens if the preferred shares were converted to common shares. So then the EPS becomes, if you convert the preferred shares to common shares, then net income, so let's write the formula first, net income minus preferred dividend over the weighted average number of shares. If the shares are converted, the preferred shares are converted, then there is no preferred dividend, and your net income would now be 2.5 million. Divided by the weighted average number of shares. What happens to the weighted average number of shares? It goes up. So initially we had 1 million, plus now if the preferred shares are convertible, or if the preferred shares were to be converted, we will have 0.4 million new shares, new common shares. So our new EPS would be 2.5 million divided by 1.4 million, which is equal to 1.78. Notice that there has been a dilution in the EPS. Dilution means that EPS has gone down. So basic EPS was 2.3, and now the diluted EPS is equal to 1.78. So whenever the EPS goes down using the if converted method, we also need to analyze the diluted EPS number. It isn't always necessary that convertible shares will cause dilution. It is possible also to have something called anti-dilutive shares, and let's look at an example. So continuing with the sorts of numbers we just saw, net income 2.5 million, preferred dividend 200,000, weighted average number of shares 1 million. Now in this case, the preferred shares are convertible to only 10,000 common shares. So what happens to our EPS now? The basic EPS does not change, because in the basic EPS we do not assume that the shares are converted. But let's now see with the if converted method, what happens to our, so we are now calculating EPS using the if converted method. The numerator is 2.5 million, so that's net income minus preferred dividend. Preferred dividend becomes 0 if the shares are converted, divided by 1 million plus 1 million shares plus 10,000 common shares, which is equal to 0.01 million. So in the denominator we have 1.01 million. So the EPS now becomes 2.5 divided by 1.01, which is 2.47. Notice that this 2.47 is now higher than the basic EPS. When we have a situation such as this, then we actually what we say is diluted EPS is equal to basic EPS, which is equal to the number that we calculated earlier, which was 2.3 million. What we definitely do not do, so we cannot say that diluted EPS is equal to 2.47. This would not be correct. Now that you have seen some examples, I think you'll be able to understand these terms a little better. Some instructors give this complicated instruction first and then give examples. I have found that, and that's what I used to do, but I think now that you've understood the examples, you will be able to relate to this text a little better. So what do we mean by simple capital structure? So this is a capital. So capital structure, very briefly, is how a company is financed. So the relative proportion of debt, preferred shares versus common shares. So in a simple capital structure is one that contains no potentially dilutive securities. So for example, here it will, so in a simple capital structure we'll only have common stocks, non-convertible bonds, non-convertible preferred stock, etc. So that would be a simple capital structure where we just calculate the basic EPS. There will be no need to calculate a diluted EPS because there are no, so we don't have any securities or instruments that might create dilution. In a complex capital structure, we have potentially dilutive securities such as options, warrants, or convertible securities. What we just saw in the previous example was a complex capital structure where we had convertible preferred shares, and these potentially created dilution. This will again be a quick summary of what you've seen. What are dilutive securities? So options, warrants, convertible debt, or convertible preferred shares, which is what you just saw, that would decrease EPS if exercised or converted to common stock. So in an example we saw a short while ago, we had convertible preferred shares which when converted to common stock diluted the EPS. So in that case the preferred shares would be referred to as dilutive securities. Anti-dilutive securities are stocks, are options, warrants, convertible debt, or convertible preferred stock that would increase EPS if exercised or converted to common stock. So we also saw an example of convertible preferred stock which were anti-dilutive. Okay, some other kinds of securities that might create dilution include stock options. So let's look at a quick calculation here. Let's say you have again a situation where net income is 2.5 million, preferred dividend 200,000, weighted average number of shares is 1 million, and the company has issued 40,000 stock options to its senior management. And these stock options have an exercise price of 15 and an average market price of 20. What this means is that the senior executives can come to the company and buy the stocks for $15. So an option with an exercise price of 15 means that the executive can pay $15 and get a share. And then why would an executive want to do that? Because he can then take that share and sell it in the market for $20 and make a $5 gain. So how will this impact our diluted EPS? Remember, basic EPS remains the same as what we've talked about before. So the basic EPS would continue to be 2.3. But how would we calculate the diluted EPS? This would now be the numerator, which would remain 2.3 million, which is net income minus preferred dividend, divided by the new number of shares outstanding. So we will have 1 million shares originally. What happens when the management team exercises all these options? So if these options are exercised, then 40,000 new shares are created. But the company also receives, so if 40,000 new shares are created, that means 40,000 options are exercised. How much money does the company get? The company will get the exercise price per option, which is 15, times the number of options, which is 40,000. So this is equal to 600,000. So the company will get $600,000 when executives exercise their options. And we assume here that the company is going to use the $600,000 to buy back shares. So if the average market price is 20, the number of shares that will be bought back, so our treasury stock operation number of shares bought back would be 600,000 divided by 20, which is equal to 30,000. So the net effect is that 10,000 new shares are added. Where did this 10,000 come from? This 10,000 comes from the fact that 40,000 new shares are created, of which 30,000 shares are bought back, and net effect is an additional 10,000 additional shares. So our diluted EPS would be 2.3 million divided by 1 million plus 0.01 million. So we do this calculation and we get our diluted EPS. So what you have just seen is called the treasury stock method. The treasury stock method assumes that the funds received by the company, so in our example that was 600,000, from the exercise of the options would be used to purchase shares of the company stock in the market at the average market price. So the average market price was 20. So in our simple example, we assumed then that the company will buy back 30,000 shares. The net increase in the number of shares which is the denominator, is by exercising the option less the number of shares hypothetically repurchased with the proceeds of the exercise. So we said that 40,000 new shares are created when the options are exercised minus 30,000 shares hypothetically repurchased. So the increase in the denominator, which is the number of shares outstanding, would be 10,000. Now let's see what happens with convertible bonds. So first three bullets are like what you've seen before. Let's say that the company has convertible bonds which are convertible to 100,000 common shares, and the interest on those bonds is 200,000. The tax rate is 40%. How will we calculate the diluted EPS? So let's go back to the formula. We have net income minus preferred dividend divided by number of weighted average number of shares outstanding. So what happens to the numerator? If the bonds are converted to common shares, notice that the net income will change, because net income had been calculated after subtracting the interest payment. So clearly there will be an increase in the net income. So let's calculate that increase. So initially our net income is 2,500,000 minus the preferred dividend, which is 200,000. And then what's the increase in the net income? The increase in the net income would be equal to 200,000, which is the interest that now does not have to be paid. But since interest is tax deductible, we need to multiply this interest amount by 1 minus the tax rate, which is 40% or 0.4. So why do we multiply this by 1 minus the tax rate? This is a fundamental concept that I will create a separate little video on. but for now just take my word for the fact that when we add back interest, we need to make this tax deductible by putting in 1 minus the tax rate and divided by the number of shares. So the number of shares is 1 million plus the new amount of shares created, which is 100,000. So you need to simply do this calculation and you will get the diluted EPS for this scenario. So we are nearly at the end of this rather long reading, done with EPS. Now we will talk about some basic ratios. This is quite straightforward. You just need to memorize some of these terms and ratios. When we talk about a common sized income statement, this shows the income statement items as a percentage of overall sales or revenue. Gross profit margin is the ratio of gross profit to sales. So gross profit, remember, is your sales minus cost of goods sold, and the gross profit margin is gross profit divided by sales or revenue. Operating margin is the ratio of operating profit to sales, shown by this formula. Net profit margin is the ratio of net profit to sales. So all these are profitability ratios, and essentially they tell you how much money a company is making relative to revenue. The final point on this reading has to do with comprehensive income. Not all transactions are reported in the income statement. So for example, there are 4 transactions that do not show up on the income statement. So these 4 transactions are those transactions that actually increase equity but do not show up in the income statement. In general, when there is an increase in equity, so for example, if you have inventory worth 20 and you sell this for cash equal to 30, your value of asset goes up by 10, and that 10 shows up through your income statement. And I have shown this in examples in other parts of this FRA course. But that increase in asset of $10 becomes part of your net income, which then becomes part of retained earnings, which is a part of equity. So in general, increases in a company's assets flow through the income statement. However, there are 4 cases where increase or decrease in asset values do not flow through the income statement. And those 4 cases, which you just need to memorize for now: 1, foreign currency translation gains and losses; number 2, adjustments to minimum pension liability; number 3, unrealized gains losses from cash flow hedging derivatives; and number 4, unrealized gains losses from available for sale securities. This you will see in more detail when we do the balance sheet reading next. Items 1, 2, 3, just take my word for it, learn these 3 terms for now, and in level 2, if you are still with me, we can talk about these in detail then. So that's your comprehensive income. Now a simple formula here: the total comprehensive income for a company is equal to the net income which you get from your income statement plus other comprehensive income. So the other comprehensive income comes from these 4 items. The net income comes from the income statement, and your total comprehensive income for a given year then is simply the net income plus other comprehensive income. So that's it for this very long reading on the income statement. And as I keep saying, make your learning as active as possible by practicing questions from the curriculum as well as your study notes.